Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to the corporate action reshaping markets. Today's big deals. Bill Ackman joins us just moments from now. His activist hedge fund Pershing Square making a dual IPO in the U.S. today. Plus, a potential spirits deal goes down the drain. Jack Daniel's owner, Brown-Forman, and Jameson whiskey maker Pernod Ricard abruptly terminate their merger talks. And a Bloomberg report from overnight confirmed elevator company Kone is set to become the dominant player in one of Europe's biggest ever private equity exits. Let's start with investors pouring out a glass for Brown-Forman, the Jack Daniel's owner, and Pernod Ricard terminating their major talks, ending the potential transatlantic combination. The news now potentially clearing the way for Southern Comfort maker producer Sazerac to make a deal with Brown-Forman. Bloomberg senior deals reporter Michelle Davis joins us to discuss. Michelle, what fell apart here? What went wrong?
I mean, as you said, it was a bit of a surprise and kind of abrupt, because as of a week ago, we were hearing that the two were still hot and heavy, and with the Kentucky Derby coming up, it seemed like the perfect timing for them to announce something. Ultimately, there were controlling shareholders on both sides of this deal. Whenever there's controlling shareholders involved, deals are tough. When there's two involved, it makes it even tougher. And we heard that they just couldn't come to, as they both said, mutually acceptable or agreeable terms to get this deal across the line. The Sazerac question is a big open question, because obviously they have expressed their interest in Brown-Forman. At this time, sources are telling me that they're not in active talks. We'll see if that changes down the road. The other big question mark is whether down the road Pernod and Brown-Forman decide to resume talks, because the way they both put out their statements, they kind of left the door open for something to happen down the road. So we will see.
I mean, this would be different, though. It's a private company that would be taking them over, not a publicly traded one.
Exactly. But Sazerac also, could have its own challenges. Analysts have pointed out that there's a bit more overlap between Sazerac and Brown-Forman than Pernod and Brown-Forman, primarily because it's two American companies that would be, a major player in American whiskey. But the Sazerac offer does contemplate for Sazerac maybe having a bigger role in the future of the company than what would have been contemplated under a Brown-Forman Pernod deal. And so it's unclear if Brown-Forman's actually open to that. We did hear that they were favoring a Pernod deal, so the jury's out.
Michelle, thank you very much. That's Bloomberg's Michelle Davis. And deal makers have also been active in the pharma space this week. Let's go now to Scarlet Fu for a roundup.
Danny, we've got a couple of cross-border deals to boot as well. First up is Italy's Angelini Pharma, eyeing a bid for U.S.-listed Catalyst Pharmaceuticals. Bloomberg has learned that the talks are still at an early stage, and Angelini, which makes popular OTC medications for pain relief, is reviewing other possible targets as it tries to expand its global footprint. Catalyst, by the way, develops treatments for rare diseases. Meantime, India's Sun Pharmaceutical has moved into the ranks of the world's top 25 drug makers, I should say, now that it's buying women's healthcare company Organon in a deal worth almost $12 billion. New York-listed Organon was spun off from Merck back in 2021, and it's got a portfolio that includes breast cancer, contraception, osteoporosis, and menopause. And finally, Eli Lilly shelling out up to $2.3 billion in cash to buy Ajax Therapeutics to further build out its oncology pipeline. Lilly has been using the cash generated by its obesity drugs to invest in other areas like cancer and gene therapy. Last week, Lilly bought blood cancer specialist Kelonia Therapeutics for as much as $7 billion. Danny?
Scarlett, thank you so much. And later this hour, we're going to be speaking to the AstraZeneca CFO Aradhana Sarin, fresh off of earnings. Now, another big deal we're following. Shell has agreed to buy Canadian oil and gas producer ARC Resources, a $13.6 billion deal. It's Shell's biggest in more than a decade as it seeks to sustain output in the long term. The company's CEO spoke with Bloomberg Tech about the move.
I'd start off by saying, actually, this is just an important point on the journey that we have been on, a journey that started over 3 years ago, where we said we want to methodically transform the company, and that's what we've been doing. And so the inflection point came that as we continue to deliver performance, discipline, simplification in Shell, we felt that it was time to look at more and more capital reallocation, and we felt that we had earned the right to be able to grow. And so the announcement yesterday for ARC was essentially just a step in that journey that we have been on. We had been looking at ARC for over 2 years. And so that, of course, predated the Middle East crisis. I've particularly been attracted to multiple elements of ARC. I mean, first and foremost, this is a liquid-rich play, high-quality resource, low cost, long duration, in a terrific basin like the Montney Basin with low carbon intensity molecules. And so we like that piece of it. We like the synergies, the adjacency to our own assets and the integration into LNG Canada, our LNG project in Canada there. And then thirdly, we really like the people. We like the culture that they had developed over 30 years. And so this well predated the crisis, but of course, always helpful to be able to have a diverse source of supply to meet the growing energy demands around the world.
Shell CEO on Bloomberg Tech. Now, the big deal of today, and it's a day that's been years in the making for Bill Ackman and his hedge fund Pershing Square. Pershing has raised a $5 billion for a U.S. dual IPO in pursuit of a Warren Buffett investing powerhouse. And for our radio and TV listeners, I want to welcome Pershing Square CEO and founder Bill Ackman. Bill, thank you so much for stopping by today.
Of course, thank you.
So as I mentioned, this has been years in the making, at least 2 years. It's had fits and starts, much like this American IPO market itself. What was it like to get this over the line?
It's great. It's a great day, but it's really, it's the beginning, right? The beginning of a journey.
So it's the beginning of a journey, and now armed with $5 billion. How quickly can you put that to work?
Actually, we think it's a very good time to put the capital to work, and we invest in the most liquid companies in the world. So it's weeks, not months.
So it's weeks, but there's this question. So some of the companies that you own in your other portfolio, for example, Uber, Meta, they've had a good run, and you're already very long them. So the question might arise, is now the right time to be doubling down?
Actually, I think the companies you mentioned are very cheap stocks today. Interestingly, some of the best businesses in the world are trading at the lowest multiples they've traded at, in some cases, in history. Actually, those multiples bottomed maybe 2 weeks ago, so we're a little bit off the all-time bottom, but very bullish on the economy, and there are some amazing businesses available at really cheap prices. This will be kind of a continuation of what we're doing now, so we're going to just add to existing positions, which will give us more ownership. And in our strategy, we like to be a big shareholder.
As you said, very liquid stocks. So the market is there. What about for like a Fannie or Freddie, where they trade OTC? How does that work? How do you dive back in without moving the market?
We're going to be very thoughtful about the way we deploy the capital, and we're not going to tell anyone on TV what we're going to do.
I see. So, you don't want to front run anyone. Yes. Perhaps a wise decision. And look, you've discussed, you were talking about it earlier this morning on CNBC, that closed-end funds, they trade at a discount to NAV. That's not a surprise. So what does success look like in this scenario? Is for example, like a 10% discount okay? So
I want to give you a new construct to think about.
Please.
Okay, so there's hundreds of closed-end funds, but they're a very different animal for what we're doing here. We're adopting the closed-end structure, the legal structure, the corporate structure, because it's the most flexible and most tax-efficient corporate structure in America. It's never been used for the purpose that we're going to use it for. But if you think about our business as a business, think of us as an investment holding company. It's a business that's earned a 19% return on equity for the last 22 years. If you look in Bloomberg, someone should do a search real time. Find me a business that's earned 19% on equity for the last 22 years. It trades for less than 2 times book value. And we're taking the company public at book value. So we think that's going to be a cheap price. Now, the nature of IPOs are such that in the first couple of days, I can't tell you exactly what's going to happen. But over time, we're going to compound this book value, or NAV, as some people call it, if we do anything like what we've done in the past, a high rate over time, and it's going to compound and it's going to grow. And we're going to run it like a real company. Closed-end funds are kind of a backwater. No one actually wakes up and gets excited about investing in a traditional closed-end IPO. They're kind of generic. You don't know who runs them. I bet Bloomberg's never even run a story. And they don't hold conference calls with their shareholders. They don't have particularly distinguished boards of directors. If this were a C Corp, no one would be asking me whether it should trade at a discount or not.
Sure.
But you can't deploy our strategy in a C Corp, which is why we've chosen this structure, and it's more tax efficient than a C Corp. It's a flow-through entity for tax purposes. So more tax efficient, and then we fix the things that are problematic about closed-end funds. So it's the lowest cost compensation for a management firm like us to manage this pool of assets. In fact, we charge our other funds incentive fees. We don't do so here. We're not permitted to do so here. So it's the lowest cost version of Pershing Square. You take our record over the last 8 years since we've had permanent capital, it's been a 24.9% return. That's a very high rate of return relative even to the stock market, which did about 10% per annum, not as well. So it's a liquid way to invest in Pershing Square at very low cost, and we're going to build the value of this entity over decades.
Well, and I know you've said before.
Now, by the way, that's just one of the companies we took public today.
That's true. And you have Pershing Square, the holding company, the holdco, and you also have ambitions to maybe list more funds. How quickly can you ramp up AUM? I know you said just by the nature of what you're doing, by compounding, that you could get to $1 trillion in 20 years. Do you have your own internal targets you're thinking of?
So the first priority is to compound at a high rate for a long period of time. That's a much easier thing than doing an IPO. Right? IPOs can take management time and attention. So we're going to focus on investing. We're going to focus on getting our Universal Music deal done. We're going to focus on helping the administration figure out Fannie and Freddie. We're going to help our company succeed. And the beauty of that is it grows our AUM. And the beauty of this, of Pershing Square, the management company, or some people call it the GP, is it grows with compounding. Other asset management firms generally only grow with raising money. If you look at a KKR or the other sort of alternative asset management firms, if they stop raising money, they shrink because they're constantly sending money back to their investors. As they sell assets, they send money back. In our model, we build off a base, and if we're up 20%, the assets will grow about 20%. And so that's a very fast rate of growth without the need to raise any additional capital.
Can you rival the size of those? I mean, I know it's a very different model, but do you see yourself growing to a size of a Blackstone, of an Apollo? Over
time, for sure. And that was the point I was making. We'll have 25, today, post the closing of this IPO, we'll have 25 to 26 billion of fee-paying assets.
Does the way you invest need to change then? Because these are huge platforms that have many different types of assets they invest in.
The beauty of our strategy, we invest in the largest companies in the world, kind of large cap, mega cap companies, mostly based here. We're tiny in the context of the capital markets. We manage the money in a concentrated fashion, but with 25 billion of capital, a couple $1 billion per investment, that's small in the context of the market we invest in.
By the way, and you know, this is quite unique. As you point out, there's not really another structure that's listed like this. How are you thinking about it, though, in terms of having a listed structure, both Pershing Square and PSUS, that it is centered around you and your very small team, which I know is you see that as a benefit too. Does it change how you communicate? Does it change what you put on social media?
Yes.
Because it could impact share prices?
It does.
Well, I guess legally is one question, but beyond that.
Well, actually, believe it or not, I've been very constrained on social media. Maybe you find that a surprise. But with respect to talking about Pershing Square, there are a lot of limitations up until this moment in time. Now we have an SEC-registered entity. Our existing offshore closed-end fund, we're not allowed to talk about it in America.
Right.
And this is where I spend the vast majority of my time, so it's something we can't talk about. The beauty of this entity is we're going to be able to, we make an investment. We can say today we bought a 10% stake in company ABC. Here's why we own it, ticker symbol PSUS, and investors. We can keep very close touch with our shareholders. And one thing that Elon Musk has done very well over a long period of time is he built a base of followers that were very supportive of Tesla over time, and reduced the cost of Tesla stock. And that's been a competitive advantage that Tesla's had over time. We have already a very large base of followers in the capital markets. They haven't had a way to invest with us until now.
It does sometimes make for more volatility, though, when a post can potentially move around share prices. Sure. How do you think about that?
I mean, we're only going to post stuff that's true. I
think that's a good rule to stand by.
Yes.
At the same time, you've been pretty early in some major dislocations in this market, be it COVID, be the inflation that followed, and some really successful hedging strategies behind that. Do you see any dislocations like that at the moment, and hedging strategies you'd want to deploy?
No, actually. I think we're heading into a very good place. Obviously, we have a war still underway, but I think we have by far the upper hand. I think Iran has been denuded of military capability, and I think it's only a matter of time. Administration, I think, this move of closing the strait, I think was a kind of a kung fu grip type move on the part of the president. And I think it's putting a huge pressure on Iran. So I think we're going to get this resolved in the relative short term. I think that's really the biggest overhang on the market, right? We close the strait, obviously has an impact, some, whatever, 4 percentage points or something of oil on a daily basis can move a market, and that has an impact, causes inflation in the short term. But I think it's a short-term phenomenon. And I think once we're through it, I do see, a Federal Reserve that should be able to reduce interest rates. We have massive, AI spending. We have massive energy spending. We have a tax bill that's driving investment. Every day there's however many deals that are being announced. You have an administration that's very supportive of transactions as opposed to an FTC which would stop everything. So there's I think you're going to see lots of reasons to be bullish on markets generally.
You were pretty early in this call, posting on X that any dips would be short-lived, and they were.
I didn't say any dips. I basically called a recent bottom. Let's put it that way. I thought stocks were getting stupidly cheap. So I just sort of called it out.
They didn't even sell off 10%. I feel like some people feel uncomfortable with that. I think oil today is trading somewhere around 116, and stocks feel unbothered.
You see, you can't think about stocks. You're thinking about stocks from an index perspective.
Okay.
The index is like looking at the surface of the ocean. The index is like looking at inside the ocean, but the surface is moving around a lot. And what I mean by that is there are, a lot of stocks. There's enormous disparity there's enormous volatility. We have a lot of earnings coming out in the next 24, 48 hours. And you can see massive moves in different directions. There's so much capital leveraged, short-term focused, tightly risk managed, which means stop losses and things like this. And the result of that is that our capital markets, you can see massive moves in share prices. If you have the ability to be long-term, every once in a while, the price of a really high-quality company gets stupidly cheap because someone is forced to sell because of a bad print for the quarter or a guidance change. Really something that doesn't necessarily have any material impact on the long-term business. And those are the kind of dislocations we take advantage of.
But the dislocations, it sounds like, are over. The stupidly cheap moment has come and passed. Is that fair?
I would say we're above stupidly cheap bottom, but I still think there are a lot of very high quality. Like the way we sort of model each of our companies, we build a model. And our kind of go forward next 3-year IRR was something north of 30% at the bottom. You don't see that with really high quality companies. It's probably now in the mid-20s. It's still a very high rate of projected return for some of the best businesses in the world. And that's suggestive to me the market's cheap, or at least cheap. This is a case where the highest quality companies are cheap. I'm not saying that energy companies are cheap today.
Sure. So you have to avoid value traps essentially in this market as it stands.
I think that's a
true
of
any market. Fair enough.
Sure.
In this sort of quest to build a Berkshire Hathaway type model. So you've listed these two.
Let me clarify.
Sure.
Because I think there's a little confusion. So we're building an asset management firm that has some of the similar attributes to a Blackstone and KKR, but it's extremely investment centric. We're going to grow this business principally by compounding as opposed to raising lots of funds. So that's one. Buffett was not in the asset management business. Buffett was building a corporation over time. We have a company called Howard Hughes Holdings. We bought an incremental stake in about a year ago. I became executive chair. Our CIO, Ryan, became CIO. The full Pershing Square team became available to the company. And that's the company we talked about building a modern day Berkshire Hathaway. And the first step we took was we signed an agreement to buy a company called Vantage Holdings. That deal's going to close in the next, call it 60 days, something like this. And we're going to manage the assets of that insurer. And we're going to work with management to make sure they underwrite very high quality, profitable insurance business. If you look at Berkshire over the last 60 years, it's built most of its value becoming effectively an insurance holding company. That's what Buffett has built over time. Right. And it was his successful management of the assets. So when you heard Buffett buying Apple, it wasn't Buffett buying Apple. It wasn't even Berkshire buying Apple. It was the Berkshire insurance subsidiaries buying Apple. And we're going to do the same thing. We're going to manage this. So the goal of Howard Hughes is to build a long-term, diversified holding company akin to what Buffett has done over a long period of time.
And sort of defining what your various holdings and your investments look like and what they're not. I know one distinction you've made very clear, because there have been these nerves around retail funds, but it's been really centered around BDCs and private credit. And you've really drawn a distinct line that these are not, there's no exposure there.
Correct.
I wonder if part of that, though, is skepticism of the asset class itself. Is there any skepticism of that asset class?
Of private credit generally?
Yes.
Look, anytime you have an asset class grow very, very quickly with a lot of participants competing, return, you either have to accept lower returns or more risk. That's the only way you can kind of grow in that environment. And there's, like everything else, there's a continuum of quality in terms of sponsorship. I don't think there's inherently something wrong with private credit. I think the one thing I would say is investing in illiquid assets, you really should have very long-term capital or permanent capital.
And here you are on your quest to obtaining more permanent capital.
There's so much capital is managed where the underlying asset is long-term. A company, a stock, is a long-term asset.
Right.
the vast majority, what's caused the stock market to behave the way it does is the vast majority of asset management firms have very short-term money. They have money that can leave in a minute, an ETF. They have money that can leave overnight in a mutual fund, or even a hedge fund. When we bulk of our assets were hedge funds, about half the money could leave every year. It's hard to be a long-term investor if your money can leave overnight.
So one of the arguments for that, though, of being able to redeem is just you're accountable to shareholders. How do you keep that? How do you keep accountability to shareholders when they're not able to redeem assets out of the fund?
Shareholders have more liquidity than they do in any fund because they have a stock that trades and they can buy and sell over time.
What needs to go right on the flywheel? Because if you do have any sort of discount to NAV, does that make it more difficult to list other vehicles like this?
We're going to focus on doing a great job for the PSUS shareholders. And if we do a great job, we communicate to them well, we deliver the kind of performance we have over time, we deserve to trade at a premium as opposed to a discount, right? Again, the average closed-end fund, the best performing closed-end fund over the last 8 years generated a 14.5% return. At its time, we generated a 24.9% return. That's a huge disparity. And by the way, that fund trades at a 15% discount. 15% premium.
Do you think you could trade at a premium?
Here's my argument, right? Businesses that earn the kind of return that we've generated over time trade at 2 to 3 times book value. Should we trade it at a discount to book value? It makes no sense. And we have a tax advantage, right? We have a favorable corporate structure, much more flexible, much more tax efficient, liquid, listed on New York Stock Exchange. I mean, put aside, I don't know what happens in the first couple of days after an offering, but with good shareholder communication, keep people informed, good performance, this can become a core holding. And by the way, the bulk of this entity is sold to very long-term holders.
Right.
And so now, with so much of the stock held by long-term holders, it's the marginal buyer and seller that will move the price around.
By the way, are you as excited as everyone else is about getting to hear from you quarterly now when you give quarterly updates? Or do you wish it was semi-annually?
No, I'm very happy to I enjoy communicating, and I certainly enjoy communicating with people who've entrusted their future to us.
Yeah.
We actually operate, you're not as aware of this, but today we do quarterly conference calls for our existing vehicle.
Sure.
We're now going to be able to do them onshore.
Yes.
We're going to be able to answer questions from shareholders the way that you would want those questions to be answered.
We're very much so looking forward to that. Bill, thank you so much for your time this morning. We appreciate it. Bill Ackman, CEO and founder of Pershing Square. Coming up on the show, Kone, more deals, is elevating its market cap in one of the biggest deals in Europe. We're going to take a closer look during our alternative view. This is Bloomberg Deals. Time now for Alternative View in one of the largest private equity exits ever in Europe and the largest deal in Finland's history. Kone is buying TK Elevator for more than $34 billion. Joining us now is Bloomberg's U.S. Deals managing editor, Liana Baker. I don't know, I feel like the barometer of Finland's largest deal is probably low.
It's also the largest deal in the elevator space.
Okay.
It's going to be really transformational.
Yes.
But it's great news for Cinven and Advent that got in 5 years ago, and they're basically doubling their money. Although Kone out of Finland is paying $20 billion in stock and cash, so these PE firms could be tied up for a while with stock. So that'll be interesting to watch how they exit it over the years. And the deal's going to take a while to close as well.
By the way, I'm guessing that it's no mistake that the deal at hand here is like a hard asset deal. Are these the types of exits that are really getting done, versus software, tech, et cetera, those fears?
Ton of interest in industrial assets and real hard assets. And not only do they make the elevators, but they service them for years. So once you put in one of these elevators, you might be paying revenue all the time. So instead of paying for software, you're paying for these services that should be pretty lucrative.
By the way, fair to say that both here and in Europe, capital markets are really robust. The fact that we're seeing this deal size in a year where Europe is plagued by, for example, issues of energy around the war in the Middle East.
Kone, though, their stock is down because it is their largest deal to date, and it's such a big bite for them that I think it was a bit of surprise to the markets that they were going to do this.
All right, Liana, thank you very much. That is Liana Baker from our Bloomberg Deals team. Again, one of the big deals of more than $30 billion for an elevator company in Finland. Coming up, we're going to be speaking with the AstraZeneca CFO fresh off of earnings. Are more deals in the books for them? She'll join us alongside Katie Greifeld. This is Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. Let's bring in Scarlett Fu, who today is taking a closer look at travel and leisure now that a bunch of travel, airlines, and hotel companies have reported earnings. Scarlett.
Danny, the number one question that companies are confronting is how are they dealing with rising fuel expenses tied to the Iran war? So let's start with JetBlue Airways. Like the legacy carriers, JetBlue says it's not seeing a drop-off in demand, but it is passing costs on to consumers through higher bag fees and airfares. And it's reducing the number of flights on offer and plans to remove even more capacity after the summer peak. Then you've got Hilton. The hotel operator saw strong growth across its brands and from premium to economy offerings, with revenue per available room rising 3.6% globally. Its home market, the U.S., grew alongside every other region except for the Middle East and Africa, which posted a 1.7% drop. Now, on the other hand, Booking Holdings forecast lower than expected sales growth for this quarter and cut its full year outlook. The online travel company cited deteriorating travel demand. As for other earnings on deck, we've got Hyatt, Marriott, and Airbnb this week and next, along with cruise line operators Royal Caribbean, Norwegian Cruise, and Viking. Carnival already gave us a glimpse when it reported double-digit increases for full-year bookings and anticipation of the highest fuel costs since 2022. Danny?
Scarlett, thank you very much. And that brings us to this week's Investment Committee, where we take you into the boardroom for debates in real time. Today's Investment Committee, Travel and Leisure, and our committee members, Tom McCaleb, he's Managing Director and Partner at BCG, Jonathan Goldstein, CEO of Cain, and Ariel Granoff, Managing Director at LionTree. Thank you all so much for joining. Just quickly, I'd love to go around and kind of get your investment thesis, your pitch for the IC today. Ariel, what do you think is the most attractive area within travel and leisure right now for deal making?
So I think near term or longer term, because I think that's a really important point for the sector, because I think that the near term dynamics, because of high interest rates and concerns around consumer spending, may actually be different from the medium to long term.
Let's start with short term.
All right, so short term, in this higher interest rate environment and with concerns around consumer spending, investors are super focused on companies that are asset light, service heavy, leisure and entertainment opportunities. These are things that have low build costs, low startup costs, and pay back relatively quickly. The other edge of that sword, though, is that you have to believe that these things can scale. And so how do you achieve scale? You have to believe that it can expand to different markets, potentially different geographies, and you can really only do that with really strong IP and a really strong management team to oversee that expansion. So,
all right, we'll get to the long term in a moment. Tom, maybe we keep this frame of reference, since I have a feeling others might feel similar. Tom, what do you think is most attractive right now?
Well, in the short term, I think you're going to see a major change from the previous decade, significant M&A activity in the airline industry. Earlier this year, there was already one deal that was announced and then approved very quickly. I think that's not going to be the last deal that you see. A number of catalysts for that, including high fuel costs, but also margin pressures that had already existed. Labor costs have been rising dramatically, especially for value carriers, and some openness from the current administration that just wasn't present a couple of years ago when large deals did not go through regulatory approvals. That may happen this year.
Sure. I mean, even to have the idea of United American floated, even if it's not going to happen, is telling in itself. Jonathan, let me bring you in, because obviously you're not in the airline sector, but this is your life in real time, looking at interesting investments to invest in. What do you think short term? Are there attractive assets out there? Is now the time, or is it time to hit the pause button?
Well, I think that it's important to focus at both a brand and an operational level in the worlds that we operate. As you say, airlines has not been our stock in trade, but really, assets or the brands themselves. And I think you're looking to invest in brands that have a distinctiveness within their marketplace and actually hold or dominate their sector. Our investment in Ackman a few years ago is a great example of that. And they've, grown and matured into, without doubt, the preeminent brand in their sector. So for me, I think we've seen great resilience at the top end of the marketplace, great transfers of wealth through generations, creations of wealth over the course of the last 10, 20 years. So we've really focused on the top end, and we like it from a brand and from an asset perspective.
Jonathan, how do you think about other brands that haven't yet established that? The Ackman is a great example, and it's been around for some time and has become synonymous with luxury. Are there opportunities out there that maybe haven't reached that status yet, but could rival it and can get there? Do you look for those kind of unsung heroes?
No, absolutely. Well, we've done it ourselves, and we're doing it this week, actually, with the Delano in the brand, which we own both the asset in Miami Beach, which is reopening this week, and we own a big piece of the brand in partnership with Ennismore, the wholly owned subsidiary of Accor. And I think the point that Ariel made is really important. You need to invest in brands with distinctiveness. You need to invest in brands which have great DNA, and they need to have great management teams that are capable of rolling it out and making sure that what the client wants to get and what the client expects to receive when they arrive at a property, they receive. Because there's nothing worse than a client who's disappointed at the end of their trip.
Man, due diligence must be hard these days to do something like that. Ariel, I mean, how do you find that? How do you find the distinctiveness? What are sort of the moats and the key factors you look for?
You know, I hate to say it's a gut feeling, but sometimes, I met a management team recently that is a relatively small business, not on anyone's radar yet. But you spoke with these guys and you watch someone analytically think through a lot of those things I was just talking about, right? How can we scale and do it profitably and efficiently on one end of the spectrum, but also how do we create a phenomenal experience for our consumers? And people that have I've seen a lot of entrepreneurs that have a really great mindset at one or the other. Either they're financially very savvy and they unfortunately don't provide a fantastic experience, or they're incredibly creative, but they don't have economics in mind. When you see a management team that can speak eloquently about both of those things together, I think that's really when you have a winner.
By the way, are these opportunities more mid-cap? Are there large-cap opportunities? Are they small? Where on the spectrum do they exist?
I mean, this is a very fragmented space, so I would say there's a lot of really interesting opportunities in that mid-cap and small side of the spectrum. As mentioned earlier, I also think there's some really interesting large M&A, but specifically what I'm talking about, businesses that you can invest in today and scale over 5 to 10 years. There's a lot of really interesting businesses in that anywhere from $5 to $20 million EBITDA range.
How are you seeing where the deal activity is concentrated? You mentioned the large cap airlines. Does that mean that it is your expectation that the bulk of volume is coming from the larger end?
I think that's the category that will be different to the previous years. If you think about hotels, there have been 3 to 4 significant but small to medium deals by the large brand companies every single year for the past 4 or 5 years. So I think that's going to continue inevitably. I think if you look at some other categories like travel distribution, the online travel agencies and others like that, it's probably not going to happen this year, but over the next couple of years, there could be some real disruption in those sectors that leads to pressure and a shakeout.
By the way, we only have a couple minutes, but I would love to just kind of leave. I hate to leave on the negative, but we have to talk about some of the risks. Tom, when you're evaluating deals, what tends to be the top risk that's bubbling up? It seems like not regulatory, by the way, if we're talking about some of these big cap deals.
Well, I think it would have been a very different story in that respect 2 years ago. It's really been untested. So far, there's not yet a boom in deals. So I think there's a lot of discussion, speculation. We see it in the media every day that deals will go through that are at a different scale than you would have expected, say, 3 or 4 years ago. That's still a huge risk until it's proven. I do think the financial value of the deals, there have been some very large deals in theme parks, in hotel management that were premised on scale that really haven't materialized, at least yet. So I think the diligence has to work on the sharpness of the thesis and the reality, especially if the deal thesis is scale.
Well, Jonathan, you certainly have a sharp thesis. I think that is fair to say. What are sort of the risks that you're looking at it as you're evaluating deals? Because it sounds like the higher end consumer is holding up. That doesn't seem like as much of a risk. Maybe it is on your mind. What are sort of the top when you head into an IC of risks that you need to evaluate?
Well, I think if you're looking today, you can't avoid geopolitical risk and the impact of, the world's economy, of what's happening at this moment in time. Potential, inflation, return to a higher interest rate environment, potentially. I think these are the factors that one's really needs to think through at this point in time. So, when you're looking in the hotels business and across all the sectors from budget to luxury, the occupancy rates in the Middle East have plummeted, unsurprisingly. Dubai's been less than 10% occupied, for the whole time since the war started. And, you don't know how long that's going to last. And the knock-on effect on air travel around the world has been seen across very many of the airlines. The rerouting around the Middle East and the extra cost that's incurred are extra factors. So whilst I'm a massive believer in the Middle East in the medium term, I think that the Gulf countries will come out of this very, very strongly, and people will understand the resilience and the quality within those marketplaces. I think in the short term, you have to factor in quite a low occupancy and low revenue generation in those areas. And there's been a big investment in those areas in hospitality by many of the brands and by many asset owners over the course of the last 5 to 10 years. And this year, they're having it a bit tougher than maybe they expected.
Right. Sorry to jump in, only about 30 seconds left, but Ariel, just quickly, similar risk profile to you that you're examining?
I'm looking at the health of consumer balance sheets. Saving rates are lower. Buy now, pay later services have higher delinquencies. I think it's going to create a near-term impact where people are going to focus a little more on local and regional.
All right, thank you all so much for joining. It's been a pleasure to have you. Thanks to today's investment committee, that's Tom McCaleb with Boston Consulting Group, Jonathan Goldstein, CEO of Cain, and Ariel Granoff with LionTree. Coming up, we talk about the pharma industry's place in the deal pipeline and earnings. AstraZeneca CFO, fresh off of their corporate results, joins us next alongside Katie Greifeld. This is Bloomberg Deals.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, the S&P 500 and NASDAQ 100 are hitting session lows, with Axios reporting that President Donald Trump has rejected Iran's offer to reopen the Strait of Hormuz, signaling this standoff could drag on. Oil prices are climbing on signs the blockade of Iranian ports may be prolonged, raising fears of a sustained supply shock that's already rattling global energy markets. Elsewhere, one person that will likely have to battle inflation soon is Kevin Warsh. He's won Senate Banking Committee backing in a 13-11 party line vote, moving closer to becoming Fed chair. Democrats are pushing back, warning his confirmation could give President Donald Trump more influence over monetary policy. In company news, Starbucks shares are rising for their best day in a year. That's after the company reported better than expected quarterly results and said it now sees comparable sales rising at least 5% this year. That's up from its previous view of 3% or more. The results show that CEO Brian Niccol's turnaround plan is paying off. And finally, investors are about to get a major read on the market's direction, and it's coming fast. After the bell today, 4 of the biggest names in technology, Alphabet, Amazon, Meta, and Microsoft, all report results. If timing matches last quarter, those releases could hit the tape within just 80 seconds of each other. Those are your midday movers. I'm Nora Melinda.
This is Bloomberg Deals, and I'm Danny Berger alongside Bloomberg's Katie Greifeld. And a name Katie and I are both watching, AstraZeneca. It reported better than expected first quarter profit growth thanks to its demand for cancer medicines. One analyst saying that the muted share response may be a lack of major catalysts. Could we get some deal catalysts coming along? I want to welcome our premium player this hour. It's AstraZeneca CFO Aradhana Sarin. Aradhana, thank you so much for joining Katie and myself.
Thank you for having me.
Great to be speaking with you again. Of course, we had the results out earlier this morning, and you beat expectations when it comes to profit, a few other measures there. But as you know, there is a lot of focus on your pipeline right now because you look at the rest of 2026, you have multiple phase 3 studies that we're expecting here. So when you take a look at your current estimates that you presented, where do you see the most potential upside here?
So we're very excited about this year. Last year was one of our most catalyst-rich year. We had 13 positive phase 3 studies out of 20 studies that read out. This is another big catalyst-rich year. We have, again, 20 major phase 3 studies reading out, and we already had 4 positive phase 3s in the first quarter. So while execution for first quarter as well as for 2026 is a priority and meeting our guidance, it's really about the future and how we get to our $80 billion ambition by 2030. And that's why the pipeline is so important. And some of the new products that we expect to launch this year and next year is going to be critical for that.
Well, that $80 billion target by 2030, it seems like the market is more buying into the idea that that looks possible. I want to talk about where potentially weight loss medicines fit into that, because that is a crowded space. We know who the first wave players are. I know that AstraZeneca would like to be part of the second wave. And to that point, I mean, where do you think that you can break in? What would set apart your GLP-1 initiative here from some of the other existing players already in the market?
Yes, there are 2 different elements there. The first is, what does it take for us to get to our $80 billion ambition? When we had set that $80 billion ambition, it was May of 2024, and consensus estimates at that time were around $67 billion for 2030. Consensus estimates today are actually north of 80 billion. So I think there's greater and greater confidence in achieving that $80 billion ambition. I think the second question which you asked is how do we play in the weight management and obesity market? So few sort of sound bites there. First of all, the total addressable market as it relates to weight loss and obesity is much larger than we had imagined a few years ago. The total addressable market at one point was assumed to be 50, 60 billion. Today, the estimates are 100 billion, 150 billion, et cetera. Secondly, we are definitely not in the first wave of GLP-1 products, which were all injectables. Only in the last couple of months have the oral small molecules really launched, and we're sort of in that second wave because we believe that oral small molecules will transform and further expand the market for weight loss and weight management medicines. Thirdly,
right.
our
Aradhana,
strategy
if I can
actually...
just jump in, because I want to ask about that specifically, and given we are on Bloomberg Deals, how much of this are you going to have to do inorganically, and are you worried about some of the very high valuations and the hot bidding wars that have taken place over some of these assets, Metsera being among them?
Yeah, so right now we actually have the portfolio that we need. We have Ilocagripron, which is our oral GLP-1. We're starting 3 phase 3 studies in that one. We also have 9550, which is our dual-acting GLP-1 glucagon, which also, again, we have in-house. And then thirdly, we have a long-acting amylin. Plus, we did a partnership in the first quarter with CSPC, which is a Chinese company for long-acting technology, which compares to what Metsera was about, which was sort of these monthly and longer-acting injectables. So I believe today we have the portfolio. In addition, I think we are very uniquely positioned because of our ability to do combination products. So 60-70% of patients that have weight challenges, whether they're obese or moderately overweight, actually have a whole bunch of comorbidities. So they may have hypertension, they may have high triglycerides, high cholesterol, a whole bunch of other comorbidities. And we are uniquely positioned because we have the other products that we can combine with these molecules to have fixed dose combinations so that a patient can take one medicine to both address their medical need as well as lose some weight. So I think we're very uniquely positioned with these combination products.
Where else in the pipeline might you want to boost through M&A? What therapeutic areas are most interesting to you, and how much would you actually be looking to deploy in those acquisitions?
So we have defined 4 key areas, which are our key therapy areas. Those include oncology, cardiovascular, renal, metabolic medicines, respiratory and immunology, and rare diseases. And we have a pretty wide portfolio in-house already. We have 100+ phase 3 trials ongoing right now, probably one of the largest and deepest portfolio in the pharma industry. That being said, we're constantly looking for external innovation and doing a lot of licensing deals. Our leverage ratio right now is less than 1.5 times. So we have a lot of financial capacity if we wanted to. But at the same time, we also have a broad portfolio ourselves. So things really need to be incremental or add broadly to our portfolio for us to do large-scale M&A.
And before we let you go, I am interested about some investment news that we got from AstraZeneca this morning, that the company plans to invest £300 million in the UK. This was interesting to see since you had paused development of an earlier project, now coming in with this investment. And I wonder, what changed for AstraZeneca when it comes to how you're approaching your dealings with the UK?
Yeah, so I think what the decision we made to unpause some of that investment was driven by the the direction of travel that we saw and how the UK is starting to approach the reimbursement and paying for innovative medicines. One of the key challenges has been how the UK and NICE assesses the quality of life measure, which then determines what they pay for innovative medicines. And I think we've seen some of that improve over time. I also want to put the 300-pound investment that you said in context of the investment that we are making in the U.S. We announced last year that we'd be making a $50 billion investment, which is a combination of R&D as well as capital investment in the U.S. The U.S. remains our largest market, and our expectation is that the U.S. market will continue to grow and be 50% of that $80 billion ambition by 2030.
Aradhana, thank you so much for your time. We really appreciate it. AstraZeneca CFO Aradhana Sarin, and of course, Bloomberg's Katie Greifeld. Thank you so much for stopping by Bloomberg Deals. And we are still waiting for the first trade on Pershing's dual IPO. And we're going to see if that gets anywhere. Indications are below the $50 for the close-end fund. And we're going to wrap up this week's Deal Show. Up next, you're watching Bloomberg. You're watching Bloomberg Deals, Danny Berger and Scarlett Fu. Scarlett, we don't have the trading yet for Pershing Square, both the closed-end fund and the hedge fund itself. But I was just looking at what it's indicated. It's indicated to open at a bid-ask of $42.50 and $47.50. The IPO is 50, so that would mean it would open at a discount to NAV. I mean, Bill Ackman, who joined us moments ago, was excited about it, but he just barely squeaked this across the line at $5 billion.
And closed-end funds have not done as well, right? I mean, they've been trading at a discount, so this is kind of a part of a longer trend.
Yeah, he did say, though, that he thought it could eventually trade at a premium. He thought he could grow to the size of a Blackstone, those other alternative asset managers. So the man certainly has
good goals.
Big ambitions. Got to have good goals. All right, that does it for Bloomberg Deals. And stay up to speed with our Bloomberg Deals newsletter. Up next, it's Balance of Power. See you same time, same place next week.